In the taped workshop which follows, coach to elite traders Charles Faulkner will explain the key ingredients for the successful futures trader. Charles draws large crowds to seminars he does all over the world. He also trades his own account.
Thank you. Thank you. Some of you may know my work from The New Market Wizards, Jack Schwager's best-selling book. And that has opened additional doors to me. I have been privileged to meet a number of remarkable market wizards and people who would definitely be considered market wizards if Jack were ever to do a third volume. And I like to share some of those experiences with you so you get a sense of what it's like to be there. For instance, I've sat while a man who understands the sweep of history is telling me about price over 100 years and political regimes and the rise and fall of agriculture as he plans his campaign in foreign currencies. I've sat while a mathematically gifted trader pointed out to me that there's an error, a mathematical error, or at least a serious misunderstanding in a major and popular market indicator, and then carefully takes the piece of paper and drops it in a shredder. I've been there as a fund manager is sitting and taking a trading idea and without notes is systematically turning it over in his head, trying out all these different possible market scenarios to find a weakness in it. And what I do in the field that I'm in, called neurolinguistic programming or NLP, is I model human excellence. That is, I'm looking for what's the essential patterns that enable these people to do what they do so well. And what I have found is even as you find such diverse trading approaches as Jim Rogers and his historical approach on one side over to pure technical analysis or day trading on the other, that certain patterns are held in common by these people. Now, in the field that I'm in, we have a couple of ideas that are worth knowing about. And one is that people's patternings are pretty much unconscious to them. So if someone's going to tell you about how they do something so great, they're really not so sure how they're doing it. They'll give you an idea or a metaphor. After all, they're good at doing it. And the other thing is that these patterns converge or align. I don't know if some of you have seen the back of the dollar bill. I mean, not the side with the eagle on it, but the other side with the pyramid. And if you look at it as a pyramid that goes up, and at the top there's this eye. In my experience is that the market wizards are like this top that's detached from the rest of the pyramid. And what they do is there's measurably something different. And so I began to look at that in terms of decision making. Now the other areas, the 5 elements of trading that I've covered in Jack's book, have to do with your market indicator. You're looking at screens, or you're getting data, or you're looking at charts. You're somehow making sense of the markets. Another significant thing is the emotions, how you handle your emotions in the changing market situations. Another is what do you believe, what limitations you might have in terms of how much money you're allowed or how much success. And another is the sense of what holds this together, the mindset of the trader. Today we're going to concentrate on another aspect, which is the trading strategy. That is, what is the person doing in their head when they look at those market indicators? That is, what are they doing in terms of asset allocation, money management, position size, stops, these things. What is it that they're paying attention to across a diverse number of different kinds of trades? Now, I'm going to tell you a little more about these 3 traders I just introduced you to. The first one that had this currency thing on, it went against him, and it went against him, and it went against him. And so he went with and reversed his position. And in the second case, the mathematically gifted trader, well, he keeps that indicator on his computer because he knows so many people out there are using it that if it gets a strong signal, he won't go against it. And the last guy, the guy that was figuring out every weakness in a trading system, well, he went really short the S&P 500 about last July. For those of you that remember, it went up more than it ever had. And partway through that summer, he reversed his position and came out quite well, thank you. So there's something else here, something really fundamental that's at the beginning of mastering high-risk decision-making. And that's the difference between the action that a trader takes and their understanding. Miss Raschke, the wonderful trader, pointed this out the other night to a number of us when she said, I have all these theories about the markets. I love to theorize about the markets. It's my favorite thing to do. But it has almost nothing to do with my trading. Now, it's a little different for the people that I've looked at. But they have understandings about the markets, but they know that they're just models. They're just made up. And when the markets don't go that way, they go the other way. They're not attached to their models. They're attached to their actions as a trader. It's better to trade than to explain. And they're very clear about that. So they hold those models lightly, ready to drop them at the first indication. They know they're only approximations. Or as Raschke has said, we're trying to reach perfection, but we know we'll never get there. So we begin by separating these things out. Now, the question becomes here, what are we doing when we're mastering high-risk decision-making? I ask that to you as something for you to think about. What are we doing? Well, we're trying to handle risk. Do you know that a very popular chart service, the man who runs the chart service, says in his own surveys he's taken both on pen and paper and by phone, it's less than 25% of the people who subscribe to the charts follow them. We go and we find out about all these different systems, different ideas, different books, and they tell you how you can have winning trades. It doesn't matter whether it's Larry Williams explaining his intraday or day trading strategies, or whether it's an Ed Seykota who claims, by the way, that there's no statistical evidence for day trading it could even work. So he takes long trending positions. To Jim Rogers, in his new book, who's telling us to buy land in western Turkey. Of course, the question is, how many of us are going to do any of those things, much less follow a system of our own? So when people talk about, the mental side of trading and, well, it's not that important, I've got my charts, I immediately am wondering, well, are you following your charts? What you're wanting to do if you're mastering high-risk decision-making is minimize risk. Now, I'll emphasize that again because people are not in trading just to minimize risk. People get into trading for all kinds of reasons, whether it's for the money or the prestige or the power, whatever's attached to it. In fact, there's some people that say that you're always getting what you want from the markets, particularly Ed Seykota. The idea that if people are losing, they want to lose. Now, people don't like this idea at all. But let's look at it a different way. Let's look at it through the eyes of Larry Hite. When Larry they said, do you have any war stories, Larry? Tell us what happened, tell about this trade and that trade. And Larry goes, I don't trade for drama. I trade to make money. All the trades I make are the same. Think about that a moment. Now, are they really the same? Well, having met these gentlemen and ladies, no, they're not. But what they're endeavoring to do is to minimize it, to make the trades as much the same. Think about this. If you were making decisions, which a number of us do every day, whether it's ordering breakfast at a restaurant or whether it's buying something at a store, picking up our kids something, maybe groceries, imagine if every decision you made was like, oh, God, I'm making the decision. It's really important. And you're doing this, and you're getting all upset about this decision. I mean, does that make it a better decision? Here's the thing. When you get into the trading, a number of people have this idea that if they're trading big amounts of money and putting on positions, therefore, it ought to be really exciting and upsetting because of all the stuff involved. But the people who do it really well are minimizing risk. For them, it's pretty much the same thing. Now, understand, sometimes there's also confusion about this in terms of cutting losses. The neophyte trader, when he hears cut your losses, will try to cut them to zero. Even if it means waiting for it to go down, waiting for it to come up again, right? And then it goes down. Well, it'll come back because I don't want to take a loss. Which is different from the experienced trader who's going, I cut my losses. I never eliminate them. I just keep cutting them and cutting them and cutting them. So the idea is you never eliminate risk. You're minimizing risk. And you keep trying to cut your risk and cut your risk and cut your risk. Now, if you're cutting your risk, what's the riskiest part you've got in your whole trading system? And this is another thing that market wizards have in terms of high-risk decision-making that ordinary traders don't have. Well, you were saying missed opportunities, or they'll say not following their indicators. No, the most important part of their system is right about here. meaning their emotional response. Because if they are upset when they're trading, they're not going to be trading as well. Now, here's the thing. If they say trade up to your emotional, trade up to where you're feeling a little emotionally shaky about it, or up to your level of discomfort, as one sometimes said, right? Well, I put this to you. If you are trading to your level of discomfort, you are trading your emotions and not your system. Because it's determining then your positions. See, I've been there when Tom Baldwin was getting some bonds in the market, and he flips his phone open, and he goes, excuse me a minute, how are they doing in Hong Kong? Yeah, give me 200. Puts it down. Now the thing is, for Tom, the size of 200 contracts is the same in his mind as the size of one contract. That is, he is trading his system, not his feelings. Now, I thought of this idea with the NLP, and I also had read Richard Dennis and Stanley Kroll both said, you can't make any money unless you hold an overnight position. And I'd also heard Jim Rogers say, well, you can go to college, you can get an MBA, take 2 years, and you can learn some, or you can go long the beans and learn the same thing in 2 weeks. Well, I'm being a contrarian, I went short the beans, and it went down. I went long, I went up. And, well, the thing was, I lost money immediately. It was like I put it on, and it just began to change. But I was going to hold an overnight position. And so I learned from that what this whole thing is about. Manage your emotions is another set of skills different than today. It's also something that's easily attained through NLP. The point is that once you have where you just can look at it and do it, then it becomes a question of, well, what is it that you're doing in terms of high-risk decision-making? What is the difference between a big decision and a small decision? And think of one for yourself. What's one that you've got? What's the difference between an ordinary kind of thing? You went and you picked up milk, or you did this or that, and then you went and you bought something, a watch, a car, whatever's a big decision for you. For most people, getting married is a big decision, just in case you're wondering. Well, here's why, again, think about it in your mind, because here's where NLP, it's this neuro-linguistic, we're going inside the mind and saying, well, what is the difference linguistically? That is with the words, with the language. Well, it turns out that the difference between a small decision and a big decision is, first of all, the size of the image you make in your head. And this is really interesting for people to do. Like, take a number, like, is $10,000 a lot of money? 50,000? 250,000? $1 million. One of my friends who trades on the trading floor, he came back one day and they made a mistake in his sheets, his end of the day sheets. He says, you got to see this. They made an error. And it was $880 million. And I said, do you get to keep it? Well, notice what I did with my voice there, how it got louder. The thing is, this is what we do in our minds, is that the more important the decision is, the more that we will blow up the pictures and we'll begin to talk louder, as if this is going to help us make a better decision. So it's going, oh no, I've got $50,000 on this, don't blow it! Which is where if we were buying milk, we'd go, is it a good price? What's the expiration date? So there's a mental difference that I'm claiming between the way that someone who is making high-risk decisions makes them and someone who makes them poorly. And yes, it is that literal. The fact of the matter is that when Tom Baldwin sees 200 contracts, and I was able to ask him about this personally, it is the size of one contract. He goes, there's no difference. He says, you're in the market or you're out of the market. There's no difference. So then it becomes a question, well, can you do something with this? And the answer is yes, you can. You could actually shrink down the size of those larger trades and make them smaller. And then you go, well, why do that? It makes it less important. Well, that's the idea, because people have this idea, if something's important, then if they yell at themselves, they'll make better decisions. And I found it's never the case. It's rather when people can handle something, when it's a size they can do something about, then they can bring their skills to bear on it. Another is that they'll put it up here in their mind's eye instead of moving it down here where it's something that's more equal to them, something they can deal with.